For the purposes of this section, growth investing will be defined as holding an asset or financial instrument for at least 1 year in order to profit from the sale of that asset or financial instrument at a much higher price. Generally, this increase in price will be at least a double-digit percentage growth annually. Often, the end goal is to be selling at a value a couple hundred or thousand times more than the original price. Those who profit significantly from growth investments are the ones who began purchasing at the very early stages, when the asset or financial instrument was just being introduced. This will be where fibs show their utility in identifying opportune prices to purchase at. After your fundamental analysis has found an investment with great growth potential, the next step is to define an acceptable buying price. Generally, growth investments continually break out into new highs on a steady incline. When trending very strongly, pullbacks are often only 1 or 2 fib levels deep, because the overall market outlook for the investment remains consistently bullish. For this reason, even though most pullbacks during strong bull runs are minor, it can still be in your best interest to enter or add to an investment in these situations. A strong investment during a very strong bull run will see price continue to rise. Any opportunity to capture lower prices is an opportunity, even if it is only a minor pullback of 1 or 2 fib levels. Price dips that drop for 3 or more fib levels present even better opportunities to invest at lower prices. Such large pullbacks, especially when price falls 4 fib levels or more, are usually due to an overall downtrend in the broader market, and not necessarily the particular investment itself. This example demonstrates normal price pullbacks of 1 to 2 fib levels that presented an opportunity to enter or add to an investment during periods with a very bullish outlook. As you will remember from previous sections, a pullback of 1 or 2 fib levels is very normal and often occurs as a minor price dip in an overall larger uptrend that eventually continues to move higher. In some ways, planning to enter or add to an investment when price drops 1 or 2 fib levels is essentially like entering a continuation trade, except in this case, the overall trend will last much longer and the investment will be held much longer. Price continued climbing to new highs following several major drops, and even a stock split in July 2015. The strong bull run up begins near the end of 2016 after price forms a strong base between the 80s to 100 range. With the following charts, pay attention to where the fib levels are drawn during a strong bull run. Price continued to rise after breaking to new highs. That was driven by a sustained bullish outlook. Thus, a 1 to 2 fib level pullback would be realistic. Buying anywhere around the 0.236 and 0.382 fib levels was the best course of action if an entry or addition to an investment was planned during these particular time frames. As a result of price continuing to rise to new highs, there were less past reversal points to confirm the fibs. On this chart, during the extended bull run, fibs often only had 1 or 2 past reversals to reference. Additionally, most of these past reversals were only 1 or 2 fib levels in depth. Brief price stalling and congesting can also be seen at fib levels. After price has broken past a fib, a new fib needs to be drawn. This can only be done once price begins to peak and reverse off its new highs. The next fib is often drawn from a swing low, near the site of the last breakout to this new peak, where price begins to reverse back down. This next example demonstrates the same features of using fibs to find suitable entry prices during sustained long-term uptrends. Similar to the last example, there is a strong sustained uptrend, thus we see the same characteristics. Price reversals usually only have a price dip about 1 fib level. A fib is often drawn with only 1 or 2 minor reversals that are about 1 fib level deep. Minor price stalling and congesting at fib levels is also seen. Once again, after price breaks to new highs, a fib can only be drawn once price begins to peak and reverse back down. A fib is then drawn from a swing low near the previous breakout to new highs to the point where price is beginning to peak. This leads to an opportunity to buy in a price zone around the 0.236 and 0.382 fib levels. These past two examples are rare. It is not very common to have price continually break to new highs for more than a few months and only have a few minor pullbacks of 1 to 2 fib levels. It is more common to see pullbacks of 3 or more fib levels, along with minor pullbacks of 1 to 2 fib levels. These are even better to buy long-term investments at lower prices. Thus, a pullback to the 0.5 fib level or lower can be considered to be entering bargain territory or heavily discounted territory. This example with Amazon stock chart will demonstrate the bare minimum threshold of a 3 fib level pullback for price to be considered in bargain territory. In this case, price is discounted well below the minimum threshold and drops well past the 0.5 level. As usual, a new fib is drawn after price begins to retreat from new record highs. This enormous price drop offers a fantastic discount on what turned out to be a fantastic long-term growth investment. In such a large drop, a combined fib was used to identify more desirable areas to enter. Remember, a large drop is welcome for long-term growth investors. Fibs help identify good deals at or below the 0.5 level of a small fib. When combined with a large fib, the small fib's 0.5 and 1 levels will normally line up with a level from the large fib, like on this chart. Price continued higher as expected, but this fib marks the end of large pullbacks, 3 or more small fib levels to the 0.5 level or below. Price only pulled back to the 0.382 level, in other words, a pullback of only 2 fib levels, as seen with the earlier examples with Visa and Netflix stock charts. Price continually pulls back 1 or 2 fib levels when the outlook is very bullish. This chart exhibits those features as price surges up on a steep incline after the minor 2 fib level pullback to the 0.382 fib level. It's a balancing act as the trend gains strength and steepens. The opportunities for large discount prices begin to disappear. Conversely, when price makes significant drops of 3 or more fib levels, price behavior often starts to become less stable. Choosing to enter or add to an investment is a matter of choice. If your fundamental analysis tells you growth will be strong and sustained, you will opt to buy minor price dips. This will be the zone around the 0.236 and 0.382 fib levels. By choosing this route, you will miss less opportunities of entering or adding to an investment. However, you could miss out on major discounts should price drop below the 0.382 fib level. If you plan to buy at large discounts at or below a 0.5 small fib level, you will naturally have greater chances of buying at lower prices. However, if you set your purchasing price too low, there is a greater chance of missing out on upside moves, especially during a strong uptrend where price doesn't even drop below the 0.382 level sometimes. This next example of Microsoft stock chart demonstrates a situation where fibs Identify rock bottom prices for investments that have had severe price drops but are expected to recover in the future. Again, the reasoning for purchasing an investment will be down to fundamental analysis, which in this case leads you to believe an investment will recover. Fibs merely reveal the price zone where price is likely to recover from rock bottom and begin rising again. The fibs used for this recovery scenario are gigantic compared to anything seen previously. They will use a weekly or even monthly chart to cover a multi-year time frame, possibly even exceeding a decade. The price range of the fib will also be gigantic and often cover a price drop of more than 20% from the initial peak price fell from. All previous concepts regarding large fibs are especially applicable. Long-term investors are focused on fundamental analysis. There is less emphasis on pinpointing the exact lowest price. A rough price zone marked by a fib will be adequate. This price zone is often at the 0.618 or 0.786 level. In some cases, the 1 level. In other words, a price drop more than 3 large fib levels. In this scenario, anything below the 0.618 fib level would be considered a huge bargain. The fib simply reveals tangible numbers that reveal a price range where it is more desirable to enter. The reasoning for buying in this case would still be down to fundamental analysis, pointing to Microsoft having great potential to recover. Again, these concepts also apply to investments outside the stock market. In this case, a price range around the 0.786 fib level was the end to a steep plunge for oil prices.